Power moves markets. Capital shapes the world. This is Behind Capital.
The $600 billion shock. September 15, 2008. Lehman Brothers filed for bankruptcy. Assets: $639 billion. Debt: $619 billion. Employees: 25,000 plus worldwide. It was the largest bankruptcy in U.S. history. Within hours, global markets plunged. The Dow Jones fell over 500 points in a single day. But this collapse wasn't sudden. It was built slowly, over years, through leverage, risk, and misplaced confidence. This is the financial anatomy of Lehman Brothers' collapse. 158 years of growth, founded in 1844. By 2007, Lehman Brothers had $691 billion in total assets, peak. Operations in over 40 countries, offices in New York, London, Tokyo. Annual revenue of $19.3 billion, 2007. Net income in 2007. $4.2 billion. It looked unstoppable. Stock price in early 2007, over $85 per share. Investors trusted it. Rating agencies gave strong ratings. Analysts were optimistic, but growth was heavily fueled by leverage. The leverage machine. Lehman's leverage ratio reached 31:1, meaning for every $1 of its own capital, it borrowed $31. If assets dropped by just 3 to 4%, equity could be wiped out. Its exposure to commercial and residential real estate was enormous. By mid-2008, Lehman held approximately $85 billion in commercial real estate exposure, $40+ billion in residential mortgage-related assets, much of it in subprime and Alt-A mortgages. These were risky loans. When housing prices fell by nearly 20% nationally from peak levels, mortgage securities lost billions in value. But the real danger wasn't just losses, it was funding structure. Short-term funding risk. Lehman relied heavily on repo, repurchase agreement. Markets, this is short-term borrowing. In 2008, Lehman depended on over $200 billion in short-term repo funding. That meant lenders had to renew loans daily or weekly. If confidence dropped, funding could disappear overnight. And that's exactly what happened. When rumors spread, counterparties stopped rolling over funding. Liquidity dried up. Lehman didn't fail because it had zero assets. It failed because it ran out of cash. Hidden accounting. Repo 105. Investigations later revealed Lehman used a controversial accounting technique called Repo 105. It temporarily moved up to $50 billion of assets off its balance sheet right before quarterly reporting. This made leverage appear lower than reality. Investors believed risk was manageable, but internally, leverage remained dangerously high. Transparency was compromised. Confidence weakened. The collapse weekend. September 12 to 14, 2008. Emergency meetings with U.S. Treasury Federal Reserve major Wall Street banks Barclays considered buying Lehman. Bank of America considered a deal, but both required government guarantees. Unlike Bear Stearns, rescued months earlier, the U.S. government refused to backstop Lehman. No bailout. On September 15th, Lehman filed Chapter 11. Markets reacted violently. Dow Jones fell 504 points that day. Money market funds broke the buck. Credit markets froze. Global interbank lending rates spiked. Systemic domino effect. After Lehman, AIG required a $182 billion bailout. U.S. government passed $700 billion TARP program. Global stock markets lost trillions in market value. Between October 2007 and March 2009, S&P 500 fell by approximately 57%. U.S. unemployment rose to 10%. Global GDP contracted. The crisis spread worldwide. It became the worst financial crisis since 1929. Structural weakness. Lehman's collapse exposed structural flaws: excessive leverage, over-reliance on short-term funding, complex derivatives, weak risk management, overconfidence in housing markets. The Dodd-Frank Act was introduced in 2010. Capital requirements increased. Stress testing became mandatory. But systemic risk didn't disappear. It evolved. Lehman Brothers survived the Civil War, the Great Depression, 2 world wars. But it couldn't survive excess leverage, liquidity risk, and the loss of trust. In finance, collapse doesn't happen because assets disappear. It happens because confidence disappears. And once trust evaporates, even $600 billion can vanish overnight.